I tend to like to be in a spot where I can move around and bounce around a bit, so I'm probably going to sit here or on the chair or maybe stay away from the podium, but we'll see what happens, just so you get a little bit of my style. We're going to start off with a disclaimer. If it works correctly, yay, it's working. Okay. Basically, what we're saying here is be careful about giving advice to your clients. I get into the same situation. A lot of people ask me legal advice, and I have to go, you know what? I think that from a business advice-wise, it works this way. Like if you're an LLC, I know you have limited liability, but you really have to talk to an attorney to what extent you're protected by limited liability. So if you're, as realtors, it's good to be knowledgeable about tax concepts, but be careful how much advice you give them, because it's easy to get a little thing wrong, or there's a whole bunch of subtleties that I don't have time to cover here today that you want to make sure they're working with somebody good so that they don't have a problem like that. Okay? All right, so what's our first topic? By the way, I caught a bit of that lightning storm. I put at the head of every topic, I put a picture of some of the lightning that I caught. It's not really showing well on the projector, but it's not too bad. Some of it was very cool, some of the things, that lightning storm a few weeks ago. So the first one we're going to discuss is why home ownership is still one of the best tax breaks. Okay? And the answer happens to be deductions related to real estate. All right? And that's just sort of the generic answer. Okay? In order to explain where that works, we're going to talk about Schedule A, because that's where most of those deductions go as a homeowner. Schedule A is an alternative to something called the standard deduction. How many people in the room know what the standard deduction is, just out of curiosity? Okay, I see a couple of hands here. All right, the standard deduction is a set number. I think this year it's going to be about $6,000. It goes up with inflation every year. Before they even tax you at all, they give you the first $6,000 of what you earn free. You don't get taxed on it, right? But there's an alternative method. Instead of taking the standard deduction, you can itemize instead. Okay, and so if somebody had a home that only cost $60,000 and their mortgage payments were $200 a month, they probably wouldn't itemize, because the standard deduction is going to be much higher than that. $6,000 is more than $200 a month worth of interest, which is $2,400. So the difference between itemizing and the standard deduction, especially for a married couple where the standard deduction becomes $12,000, isn't always all that big. What you're looking for numbers that are substantially bigger than the base that you're getting already. Okay? There are other items on Schedule A. So for instance, you can take charitable donations. You can take medical deductions, but they're limited. You also get business deductions such as tax prep that have some haircuts on them. You also get investment interest expense. But the single number one reason why most people change from the standard deduction at some point in their life to being an itemizer is when they buy their first home. Okay? All right. So what is deductible for real estate owners, and why does this make a difference? One is property tax, which depending on the area can be either very large or very low. Here in Maui it's relatively low, but in Texas, for instance, where they have no income tax, the annual property tax rate in some communities pushes 5%. So if you had a $100,000 home, you're paying $5,000 a year in property tax. If you have a $500,000 home, the property tax is $25,000 a year. So it can be very substantial in some communities. It's just important. The other one is mortgage interest. And that's the biggie, and we're going to get into that in a minute, right? Okay? Property tax has limits on the deduction. It must not be used for business, although if it is used for business, you can actually deduct that some other place because it's a business deduction. Now, this was one I probably had too much fun with. I went, ooh, wouldn't it be nice to kind of line them up and kind of get them in there at an angle? And I just had my coffee, and I had a little bit too much energy. But property tax timing is important. Okay? So the first one is you can only deduct the taxes that you paid that year. It's not an accrued. So if you owed years and years to the back taxes, you don't get to deduct them as you go. That year you catch up, that's when you get to deduct them all. Okay? It's what you've actually physically paid. Now that can be interesting because in many cases these days, escrow, the mortgage holds it as a part of escrow. So they have to report to you what property taxes that they paid for you. But sometimes some people are still paying their own property taxes and stuff like that. Did you have a question? Okay. All right. Any questions so far? Okay. All right. So, one other thing. If you should happen to get a refund, it's taxable. You have to include that as income. Usually you get a refund when you file for a change in the value of your property. You make or you actually sell the property, and the buyer is paying for refunding a portion of the tax that you had already deducted. Okay? So property taxes on vacation homes are also deductible because it's a tax. Just about any tax you pay is deductible at the federal level, depending on how you're doing it and what works, but it's also an AMT preference. Anybody in here know what AMT is? Alternative minimum tax. Now, I want to cover that just very briefly. It depends on your income level. AMT starts to have an effect when you break about $125,000 a year in adjusted gross income, on average. Okay, maybe a little higher. And then from there to about $800,000 to $900,000 a year in income, it's almost always there, and then it goes away because you're in such a high tax bracket, 39.6%, that it becomes irrelevant if you're lucky enough to be making. Those are good problems to have. But if you have that situation, the AMT goes away, but the basic tax rate becomes higher. So taxes are deductible for regular income tax, but if you're in that 150 or 1,000 a year, 125, 150 a year and up, you may not get the full benefit deduction because you're probably in AMT. Okay? All right, now, another place to catch property taxes. In an escrow, one of the things that the escrow company does is calculate to the day who's paying the property taxes. So like if you've already paid the property taxes for 2014 through 2015, and the escrow company knows that, they will give you a credit. Let's say you sold on December 1st, they'll give you a credit from December 1st through what you paid for, and they take that out of the sellers. Now that's interesting on two different ways. As a tax accountant, for anybody who's sold, who's our client, we have to look for these refunds and pick them up as income. For anybody who's bought, it's a nice little hidden deduction that's hiding out there, and sometimes it's substantial, a couple $1,000 sitting on a HUD-1 that we look for in order to do this. Okay? All right. Special assessments are also included in this. Okay? They sometimes get special treatment, but I haven't seen any special assessments in Hawaii that get the special treatment, so I won't bore you with that one. Okay, let's cover mortgage interest for a second. Right? There are some rules to be able to take the mortgage interest deduction, and it's sort of surprising how often these come up and ixnay somebody. The first one is it has to be your debt. Okay? So if you buy a house and you have bad credit, so your mom and dad buy it for you, but you're making the payments, you don't get to deduct that. Okay? Your mom and dad get to deduct it, but not you. And that's a pretty common scenario, especially post 2005, 2006, when a lot of people got kind of crushed and they looked for family members to help them out and dig out. So you have to be on that loan or be a debtor obligated on that loan to be able to take the deduction. Okay? Can you take them on your vacation home? Yes, question.
Real quick, how about if you have or even a recorded land contract with an owner, can you get the tax deduction that way? Or the interest deduction that way?
You have to be, be more clear, who's the debtor and who is the person making the loan?
So say somebody bought the property from the owner
Okay.
on a land contract.
Mm-hmm.
They still hold the title to the property because it's a land
Right.
contract. So they're going to be paying the mortgage payments to the original owner.
Yes.
Do you get to write the taxes off or the interest off on your taxes that you're paying to?
I believe you would in that case because they're an obligated debtor. They've bought the property under the land contract, which includes probably some principal and interest that they're purchasing. It's not necessarily a mortgage contract, but it is a recorded debt against the property, okay? And they have to make interest and principal payments on it. So I believe that you would, okay?
One more question.
Sure.
If you co-sign on a loan for someone, say your kids,
Mhm.
co-sign,
Yes.
that's a J-loan per se, do the kids get the full write-off or do you guys split the write-off on the interest?
Technically, it's who's paying it at that point. So if the kids are paying, if you have more than one obligor, both of them you could deduct it. Now the next thing you have to do, you have to be the person who actually paid it. So if the kids are the one paying it, they take all of it. If the parents are the one paying it, they take all of it. If it's sort of a joint thing, because maybe they're sharing the house or there's some other family arrangement, they'd have to split it. Now, if the parents weren't living in it, then they'd have to treat it as a second vacation type home. If there was more than one vacation home, then they might have some troubles with that. But generally, it's who's paying it at that point. Okay? Any other questions? How are we doing so far? Okay?
The limit on this is still up to $1 million?
Yeah, we're going to cover that. We're going to cover that in a second. Yes. Right there. So it's 100% deductible on the first $1.1 million, but there's actually some extra caveats on that. The first $1 million can be original equity on the house. The extra $100,000 can be a line of credit. Okay? There are some funky rules around that. Generally speaking, most people qualify. The issue comes up occasionally if the debt wasn't used to originally buy or finance the home. If they used it for something else, it becomes more difficult. So if you have a $250,000 line of credit and a $750,000 loan, for instance, the $750,000 loan is good, only $100,000 of the line of credit is good, even though you're under the $1.1 million. And that's where that limit starts to kick in. Okay? Questions so far? Okay? All right. The home mortgage interest can be on things besides a home. Any sort of second place that you could, in theory, reside in that has a roof over it, whether it's a boat, motorhome, home, condominium, all those other things. I don't know that an open sailboat qualifies, but I do believe anything that's got sleeping quarters and a bathroom, I think, qualifies. Okay? All right. Now, we're going to start to explain now why this is so much better, right? Okay, mortgage interest rate. Oh, wait, I'm sorry, no, we're not getting to that yet. Rental property versus vacation home. Okay, so mortgage interest is fully deductible on your primary residence, but there are some situations where it's not, where it's a vacation home and or a rental property. Okay, so the first one we're going to deal with here, okay, is that if you want to take it on Schedule A as a vacation home or a principal residence, you have to spend at least 14 days in it. So the boat, the recreational vehicle, something like that, you better have been in it at least 14 days to be able to take it. Obviously, your primary residence, this isn't usually an issue. Okay? Right? If you're also renting it, it gets a little bit more complicated. Okay? Now, this is a form that is actually in here. If I was handing out slides, I'm not going to today, but it goes through the checklist of how to make orders and what's deductible and where it would be deductible. We're going to kind of cover that in a bit. Okay? Okay, so this is where we discuss the renting versus owning. Okay? In a nutshell, right, the reason why owning is better than renting is because the mortgage payment, almost all the mortgage payment becomes deductible, whereas rent is not. Okay? You have the standard deduction versus the itemized, but in a typical house here, you're probably making payments of at least a couple $1,000s a month. In fact, I've used a low but pretty typical payment here. Right? So we have a married couple, they make $100,000. They're paying $2,000 a month for rent. They decide to buy a home that's going to cost them $2,400 a month. Okay? We're going to presume that $2,300, because it's a nice round number, is the mortgage interest portion, especially in the early years of that mortgage payment. It's probably something a little bit off from that, but generally I find that almost the whole thing is pretty close. So let's see what happens to them. Okay? So if they're renting, this is sort of a mini tax return for them, right? Page 1, page 2. If their adjusted gross income is $100,000, that's the bottom of page 1. They're going to take the standard deduction for a married couple. They're going to take 2 personal exemptions. Their taxable income is going to be $81,300, and their tax for the year will be $12,706. Okay, that's a combined federal and Hawaii rate, roughly speaking. Okay. However, if they own, right, their adjusted gross income starts in the same place, but now I'm getting $2,300 times 12 in mortgage interest, plus some tax on that, which used to be embedded in the rental rate because the owner of the rental property had to pay the taxes. We get a personal exemption, we still get those. Their taxable income is $6,300. Their tax due is $8,600, not $12,000. That difference, okay, is about $6,700. And again, the GE tax on the rent depends on whether or not the owner is passing along the GE or not. Some do, some don't. But if they were, that's an extra tax you're getting away from. So you divide that by 12, they're saving over $500 a month in taxes by owning instead of renting. This is still probably the single biggest tax deduction you can get. It's better than a kid in most cases, especially for a married couple. Okay? Married, head of household, sometimes the one kid can be better than this, but generally buying a home is still the single best thing you can do to cut your taxes. And I'm not really sure where it came from. I've tried to do some reading on this, but back in the 1940s, 1950s, in the post-war year, they started this mortgage interest deduction as an encouragement to people to settle in and buy homes, because home ownership wasn't encouraged at the time, or wasn't encouraged much prior to that. And then they decided that it was better to encourage people to buy homes, and so they put this in there, and it's still around 60 years later. I think it's good probably there's something in tax code that sometimes gets bandied about. There's something called, there are social engineering aspects in the tax code where they encourage society to do certain things that are considered good for society and good for the country. One of them is home ownership. It makes you proud of your home. It creates good, stable communities and other kinds of things. So they encourage this, all right? So, any questions about mortgage interest and home ownership as a tax-saving device?
Do you think they'll ever take away that deduction?
They've made noise about it. The bill that they were talking about a tax reform this summer, and they spent an awful lot of time working on it for 2.5 years, and they were doing it in secret. And then they released this thing out there, this tax reform package, and it was just dead on arrival. It was filled with all kinds of junk. But one of the things in it was getting rid of the mortgage interest deduction. Okay? They keep bringing it up in have you ever heard the phrase trial balloon? A trial balloon is when they don't know how society is going to react to something. So somebody makes a speech or somebody gets set up to put this idea out there, and they wait to see what the social reaction is to it. So if somebody says, hey, we need to get rid of that mortgage interest deduction, it's destroying our ability to rent, and it's a bunch of rich people taking advantage of it. Well, I don't know. I don't necessarily like that. I would usually tweet or do something else and complain about it because I want them to know it's not a good idea and get back to them. But they will put these ideas out there. And so when they put that in there, I think it's more of a trial balloon. Now, you actually asked, is it going to come through? I don't think so. I think that one is a sacred cow. I think they'd have a really hard time getting rid of it. I know the Realtors Association would be hiring millions and millions of dollars worth of lobbyists to go to Congress and fight that one if you tried to get that one through. So I don't think it's going anywhere. But it is something to be aware of. Okay? Any other questions?
And is PMI as well as FHA insurance tax deductible?
Private mortgage interest goes back and forth. I believe, I have to look it up for this year. It may be part of the Extenders Act that hasn't passed yet. For many, many years, private mortgage insurance was not deductible, even though in many ways it's sort of a risk. They really should make it a higher interest rate because then it would be deductible. Instead, they separated a different company to protect the mortgage lender and charge a different fee for it, but it's based on how much you're borrowing and your risk levels. It's a lot associated with a interest rate risk-reward thing. And so a few years ago, Congress allowed PMI to be deductible. But it was a test thing. They let it do it for like 3 years, then it went away. Then it came back again in an Extenders Act. And I don't think it's around this year, but I do have my book in the car. I can look it up for you later and see if it's around. That particular one I think died, and I'm not sure. There is an Extenders Act that's expected to be passed after the election, which includes Section 179 and bonus depreciation and a few other things that I have seen. But I don't know if that's in it because there was one that passed the Senate and one that passed the House, and they were different enough that I don't know what they're going to get in the final one.
How about the FHA insurance? Is that the same thing as PMI?
That's essentially the same thing as PMI, yeah. Any other questions about mortgage interest, deductibility, anything like that? Okay? All right, so let's go on to our next topic.
Are you going to cover,
Oh, not yet.
are you going to cover, like if you refi on closing costs or points and all that?
We can cover that. It's not on the slides, but I can, in fact, it might be in the miscellaneous. Let's cover a couple of these quick, and I might get that in there for you, okay?
Just one more question on mortgage interest. How far back can your taxes be audited for that?
How long ago did you file? So the statute of limitations is 3 years. So generally we keep records for 4 because it takes a while in the course of the next year to get things done. However, actually I'm sorry, we keep records for 7 years because there's also the possibility they can open up an extra 3 years if there's more than a 25% understatement or they can prove any intent to defraud. So generally the statute of limitations is 6 years. You add a year because there's the prep year in there to the year that's in question. So like for instance, we're getting ready to dispose of 2008 stuff in this year, or 07, 08. So we were done in 08, 09, 10, 11, 12, 13, 14. Yeah, 07's going away this year. 08's getting moved into the holding bin to go away.
Okay.
So generally 3 years. Now, that's from the time that you file. If you never file a tax return, it never closes. They can go back forever.
So if you do an extension, it's all the way through the extension when you actually send it in.
Right, it's from the date that you file the return. You get 3 years from that date, or 6, from the date you file.
I actually had the person doing my taxes 1 year took a lot larger deduction than $1 million.
Okay?
Like $1.5 million. And the following year, I got nailed on it. But I'm still, it was a total of 3 years. I got dinged on the middle of the year, but not the 2 on either end.
And that can happen.
Okay.
Okay? Let's see, it's not uncommon because the auditor that works your case is very heavily worked. They identify an issue, they look at it, and they correct you on it. They presume that you're going to correct it on a go-forward basis. And they don't always open up every other year because their workload doesn't allow them to. Okay? Technically, I'd have to advise you as a client to amend those years that are wrong because you were obligated to do so. At the very least, now that I know this fact, I wouldn't be able to sign a go-forward return if I knew that the mortgage interest amount you reported was actually on an amount higher than that. So those kinds of issues come up. Now coming back to your question, right? Okay, so points are actually treated in 2 different ways. Okay, the first set of points when you buy the house is actually deductible. So when you buy a house and you pay a point, let's say you pay $2,000, you can deduct that right there as upfront mortgage interest in the year that you pay it. If you refinance your house, those points are amortized over the life of the loan. And so what we have to do is say, okay, you paid, I'm going to use the number $3,000 because it's a nice round number. I divide that by 30, which is a typical mortgage loan, and I get to deduct $100 a year. Okay? The first time through, you can deduct it all up front. When you refi, you have to amortize it. Does that answer your question?
What about all the other fees? There's always a long list of fees associated with the loan, or any of those others? Or is it just the ones that say points?
Only the ones that say points can you deduct for a personal residence. If it's a rental property or any other kind of business activity, you can embed them in the cost of the mortgage and actually amortize all of those over the cost of the mortgage. But for a personal residence, only the actual points.
So like an appraisal
Would not be deductible for an individual.
for a business, it'd be amortized?
Yes, you would take the entire cost of refinancing, everything on that HUD-1 except for the property and other specific taxes, and you would wrap it up into the cost of that refinancing along with the points, and you would amortize it over the life of the loan for the business. But for an individual, the only thing that's deductible by law is the actual points. Okay, any other questions on that? Mortgage interest unqualified debt is deductible as mortgage interest. And that's an old one. I don't know if I caught that when I was redoing this one for this. Reverse mortgage interest, I think that's the question you asked before in the back over there. That one may or may not be correct this year. Okay? All right. This was an older, I took this from an older presentation we gave a few years ago. We were actually teaching 6 hours of realtor CPE for a while. And I took some of the key pieces of that and punched it up, and I think I missed that last piece because I think my information was a little bit wrong at the time. All right, so the next topic that's coming up is qualifying for real estate professional. Okay, how many of you heard this term before? Real estate professional. How many of you own rental property yourself? Got 1, 2, 3, 4, 5, 6. Okay, so how many of your rental property, if you don't mind me asking, is it throwing off profit or losses? If you don't want to say, that's okay. Profits, okay, cash flow profits, but losses, okay. Not uncommon if it's leveraged, depending on the community that you're in, that it can be cash flow positive and actually throw off tax losses because of depreciation. It depends on how much leverage you have on it and the cost of leverage and what the gross multiple was when you bought the property. Whether, you know, the amount of rent you can collect versus its price. I like gross multiples of 8 and lower, but that's really hard to find on Maui. So they are out there, but they're really hard. So what is real estate professional? Most of the time, the losses that you have, and we're going to discuss this for a second, most of the time, real estate losses are passive losses. And passive losses simply aren't deductible. I mean, I can say they are, but the truth is there's limitations on them. We're going to discuss those limits. The real estate professional is like a get-out-of-jail-free card for Monopoly, where, hey, I'm out of there. I don't have to worry about these rules, okay? And because you're realtors, you're probably the only group of people that can more easily qualify for this rule, unless you're a non-realtor who's doing nothing but rentals. And then but there's gotchas to it and other things that come around. So what we're going to do is we're going to discuss these passive loss rules, which are relevant to you and your potential clients trying to buy rental property. And then we're going to discuss how the real estate professional gets you out of these rules and why it can be valuable to what you're doing. Okay, this is probably the longest presentation we're going to give today, but it's a pretty good one. All right. So passive activities came out from the 1986 Tax Act. Prior to the 1986 Tax Act, which was put out by Reagan and the Congress at the time, the top tax rate in the United States was almost 70%. Okay, and the reason why was because there was all of these deductions. Basically, were called tax shelters. You would buy an interest in a partnership or something else like that. It would throw off losses, and you would be able to basically reduce your income to almost nothing. And then, so they had to tax a very high rate because you were able to reduce your losses. In the 1986 Tax Act, they radically reduced the top tax rate from something in the 70s to the mid-30s. But at the same time, they put several different caps on being able to take these losses. And this was the single most powerful one. They created a whole category of activities called passive activities. If you were not active in something, you could not deduct the losses against your ordinary income. So for instance, we'll use realtors as the rule in this room. Suppose you make 100 grand a year as a realtor. Nice round number, makes the math easy, okay? If you had a piece of real estate that was throwing off 25 grand in losses, you could not take it. You had to pay tax on 100 grand, not 75 grand, okay? They completely ixnayed the ability to deduct tax shelters, rent, and by definition, all real estate was deemed passive, okay? So most passive activities would be things like, hey, I bought an interest in my brother's company, I own 10% of it, he's throwing off losses, I gave him a couple $1,000, he throws off a bunch of losses to me, right? Or I bought a tax shelter marketed by Wall Street or something like that, okay? And it threw off these losses to me. Because you were not active in the company, you could not take those losses. Now, if you actually put 500 hours a year into that company, you are now active in it and you could take the losses, okay? Makes sense so far? Any questions about how this works? So since most people earn ordinary income or investment income or something like that, and most of the losses were coming from these things you weren't active in, this was a real home run for Congress. It really changed. This was probably the single biggest change that came out of the 86 Tax Act, was this passive loss restriction. It changed the whole playing field. But it's still around, okay? And they've softened it a bit, including real estate professional and the $25,000 rule, which we'll talk about. Let's make sure I've covered everything on this page without looking at it. Okay? Like real estate professional, 100-hour rule, etc. Okay, we're going to get into those things. Okay, so why does it matter, right? Let's see if I cover this. Losses from passive activities, passive income, not ordinary, includes wages, right. So we've talked about that by using an example for the two of you, okay? Now there are two exceptions. One of them is the $25,000 rule, and we're going to cover this one. This is a good rule for people who are middle class or lower, maybe lower upper middle class. If you're making $125,000 a year or less, and you're the primary person managing your real property, whether you have 500 hours in it or not, you can deduct up to $25,000 of your losses. So when I lived in California and I worked for Deloitte, and my house happened to have apartments behind me, and they threw off losses, I was able to deduct those losses. I was making, 70 grand a year from Deloitte and Touche, which is the CPA firm there. And this thing threw off 10, 12 grand a year with the losses, with depreciation and everything else. I was able to deduct those because I was under the $125,000 rule. I was active in managing the property. I managed it myself. Okay, makes sense? Okay, between 125,000, I'm sorry, 100, not 125,000. Sorry, 100,000. Between 100 and 150,000, okay, they take 50 cents off of that of what you can deduct. So at 125,000, you can only deduct $1,250 because you're halfway there. At $150,000, you can't take any of it. Now that's called a phase out. If it's not a phase out, it's something. It doesn't have a nickname, but I've given it a nickname called a light switch. What's nice about the fact that it's a phase out is if they turned it off at 101,000, then all I have to do is get to 101,000 and I lose all those deductions. So instead they phase it out over time. Many, many things are mathematically phased out because otherwise if you reach a certain number, it turns off immediately and has a radical effect on your income. This is more of a phase. So this is a little subtler about why they do that. And that's why you get into this mathematical thing. It's designed to make it not so harsh on somebody, right? Because you can literally have them make $1 more and their taxes can go by $5,000 if it wasn't phased in, because you couldn't take the deduction anymore. Okay? And again, my apologies for saying 125. After 30 years in this business, these specifics start to get a little shaky. You just work on principles. All right. So you must actively participate. You must own at least 10%, okay, and make management decisions. So one of the gotchas that comes up with this, right? On the Schedule E, the form that the IRS uses to report rental income and expense, there's a line for management, okay? One of the things I have to teach my staff is, whatever it is, do not put anything in that line if they want to take this deduction, because it's a flag for the IRS. If you're paying somebody else to management, then you're not managing it. And you've just turned this off. That's a light switch, okay? So normally what that is, it's a commission. It's like a renter's commission. We usually put that in the commission line instead. You don't want to put it in the management line, okay? And you want to make sure you're active in the management of what you're doing. Now, if you really aren't managing it, then you list the management expenses and you don't take the deduction. But if you're active in the management, don't put the realtor's commission in there, because you'll end up turning this off, or the IRS will want to audit them, okay? Not adjusted for inflation. We're going to talk about real estate professionals. Now, interesting thing, not adjusted for inflation. How many of you are familiar with the $3,000 annual capital gain or capital loss deduction? How many of you are familiar with that number? Okay? Anybody else here seen that one? If you have anybody invest in the market at all and you lost money on something, right? If you lose money on something, you can deduct only $3,000 of that number against your ordinary income. Well, that $3,000 number came in the late 60s. They never indexed it for inflation. In the late 60s, you could buy a Buick for $3,000. So that number, over the course of 40 years, has become less and less important as a real number. It becomes like a gimme that Congress never adjusted. And this 25 grand, I think, is just like that. It was created in '88, a couple of years after the '86 Act, because they thought it was too harsh on people who were doing rental property. There was a lot of lobbying to add something. They gave them a $25,000 number, but they never indexed for inflation. By the time I retire, or the youngest person in this room retires, that number won't be very significant anymore. Okay? But it is there for now, so I just want you to be aware of it. Just sort of some historical commentary on what happens to tax laws over time if they don't index them. Okay? All right. Now, the cool thing is, if you can qualify to be a real estate professional, you have no limits on your rental losses. None whatsoever. But it's very hard to qualify. And the IRS has specifically said they are going to challenge these like crazy. Okay? And they do, in fact, challenge them a lot. We've had more audits on real estate professional than anything else in the last couple of years. Okay? We've won all of them, but they can be fun. We'll talk about why. Okay? Now, to qualify, you have to have 750 hours. Okay? You also, and more than 50% of your time has to be in real property business. Okay? So let me give you an example of somebody who failed. Okay? Engineer works full-time for a company, right? He works 220, which full-time is 2,080 hours, okay? Government job, working, does his thing. He also had 12 properties, some of which were throwing off losses. He put way over 750 hours in to those properties. So he was a hard-working guy. He doesn't get the deduction. Why? Because more than half of his time wasn't spent on real estate. Most of it was spent as an engineer. So he failed one of the two tests. Okay? The 750-hour test, though, actually turns out to be much harder. We're going to get into that. Okay? So, let's see where to start with this one. Okay. You have to have material participation in each rental property in order to include it in the 750-hour count. So let's say you have 3 properties, 2 on Maui and 1 in Southern California. Okay? Material participation is defined as at least 100 hours and a few other things, right? You go to Southern California for 2 weeks, you check on your property, you come back. You say that you have 750 hours managing the 3 properties, right? And you list 100 hours for the property in California because, hey, you were there for 2 weeks. You're going to fail, okay? Because you're going to say I had 650 hours in the other 2, and that one is going to fail because you're only there for 2 weeks, and you didn't, and they're not going to believe you put 100 hours in over a 2-week period of time. They're going to challenge you on it. You might be able to justify it if you showed, hey, here's a whole bunch of Home Depot receipts. I literally got in there and did nothing but working on it. I don't have any manager there. I do everything myself. But boy, you're going to get it challenged on it. Okay? The issue is to get to 750, the only properties you can count have to have material participation. Okay? If you have 50 hours in the California property and 700 hours here, you're going to fail, definitely. Because even if you can prove the 50 hours hard, it fails because you didn't have material participation in that one. Okay? So how many properties you have, what time you spend with them becomes very important to qualify for this. Okay? All right. So let's cover each of these very specifically. You'll notice that the 500-hour rule comes up again for the passive active rule. That's the base rule for being active in a company under the passive activity rules. If you get 500 hours in that activity, you're good. Okay? Second rule, you can perform substantially all the work in the activity, but you notice I put the word careful after it. What does that mean? Well, take the California property. You have an on-site person who basically may get some free rent. They're there all the time. You're here. You go there a couple weeks a year. Let's say you do spend both weeks working on the property doing something. Did you do more than the person who's living there, dealing with collecting rent day to day and dealing with the water pipes that break and the issues with tenants and showing the house? No. They're going to have put more time in than you, and you will fail to perform substantially all the activity. Okay? You can do 100 hours. Which is substantially more than anyone else, which is basically the same rule as the first one. The first one doesn't have a 100-hour requirement. You can get by on 5 hours as long as there's nobody else doing anything. Okay? The second one is the same rule. You can get by on 100 hours, but it has to be more than anybody else doing anything. They're almost in many ways the same rule. Okay? I prefer to qualify people under this one and to make sure we have a fact set that says you're there running the property and you don't have a manager there or a realtor. I don't want to see a realtor commission, a management commission, anything like that, because those facts literally jam this up. And as I've discussed earlier, if you've got 3 properties and you're trying to get to 750 hours with the 3 properties and one implodes for some reason, the whole thing fails. Okay? All right. Now, there is a way to get around this. You can make an election, which is irrevocable, unfortunately, to take all of your properties and group them as one. All right? So we file this for you as part of a tax return. Let's say you had 2 properties here and 1 in California, and you definitely put 750 hours in across the 3 properties, and you're not sure the California property you're going to qualify for. If you elect to group them as one, now they can't ruin you by pulling one out of the mix. It's part of this group, and you don't have a problem anymore. Now, it changes some things. It's a pretty serious election. The first change it makes is what you do every year when you report it. If you've ever seen a Schedule E, it's got a column for every property you've got. You basically take the income statement for these 3 and you combine them all together and you report them in one column. One activity, one column. Second issue that comes up, if you ever sell one of the properties, okay, when you sell it, it's not a sale. It doesn't trigger any of the release of prior passive losses or anything else like that. So it's not considered a sale that releases pent up or suspended losses until you sell everything that's in that group. And if you're a realtor buying and selling stuff, you may want those things. Now this gets into a tax planning issue, to be honest with you, because if you're going to start to acquire properties, right, we're going to try and get you to the point from the beginning that you don't have any suspended passive losses, so this doesn't come up. But sometimes you were with other accountants, or you didn't plan for it. You bought one property, then you said, hey, I'm good at this. I want to become a realtor. And you've had losses you couldn't take from that property. And so sometimes you got this clump of passive losses that are out there. You can't take them when you sell the property. So if the California property is the one you had for 20 years, maybe you acquired it from your family, there's a lot of passive losses built up, and you merge it in, when you sell it next year, you can't take any of those losses, and they might have been valuable. They get wrapped up as suspended losses with all the other properties. Okay? But this is a valuable thing. The other thing that we found very valuable about this is, boy, it really shuts the IRS up when they audit our realtors. Instead of trying to find the one property in the 750 that they can sort of jam a set of facts around and carve it out, they're kind of like, it's not as easy for them. It's a lot harder. Okay? So when they start to demand facts and other stuff, they struggle. This is not a bad election to make, but it's a pretty serious one, and you have to, and it's specific to different people. I will look, if I sat down with each of you in this room and looked at your situation and said, let's consider this, I might say yes, say recommend it for half of you and not recommend it for the other half, depending on what your fact set was and what you were doing. Okay? Any questions about this so far? Okay? All right. Now, you have to perform more than half of your services and at least 750 hours in real property businesses such as this. Okay? Right? So those are them. Developing, constructing, acquisition, conversions, renting, management, brokering. I don't like to read it, but it's important. Guess what's not included? Okay? If you're a salesman for another broker, your time doesn't count. That's the single biggest gotcha out there. So if you have your own rental properties and you're not the broker in your office, okay, you're an employee, your time being a real estate professional, back on this slide, like, hey, management, brokering, renting, other stuff, none of that counts while you're working for your boss. It has to be you doing it for yourself. Okay? That's a bit of a gotcha. The IRS burned one of our clients on that one a couple years ago because it's very subtly written in the rules. Okay?
You said working for another broker, what about an independent contractor?
Right.
They're all independent, but you're working as a salesman, not as a broker. So they generally say no. Now, in this particular case, the one that we lost on, the person was actually a W-2 employee because it was primarily rentals, and so they were paid a salary. Okay? An independent contractor might have a better argument. We haven't had that one come up to the point where we've tested it yet, but we are concerned about it because they're not working for themselves. So, or they may or may not be, depending on how the law works. We're not 100% certain. And the IRS is not providing a lot of guidance. They have an audit guide, but it's a little bit cryptic, to say the least. Okay? So, but I know that if you're a W-2 employee, you're not gonna fly. You're done. Don't count any of those hours. Okay? Second issue that comes up. Okay? We talked before about material participation. If you're doing less than 500 hours, you can justify it, but you better be really careful. You got to be careful that you're doing more work than anybody else and that it's a primary target of what you're doing. Finally, the IRS will, if they audit you on this issue, they will require a time log of your time. Okay? Nobody's keeping one. It's like the car log. Nobody keeps it. Okay? But they will demand it. Right? So, it's a problem. So most of the time what people have done is made it up after the fact, which is okay. It's not required that it be this fancy word contemporaneous, which means it was created at the time. It can be created after the fact. Okay? But it's actually a lot easier to keep track of it as you go in your date timer. Most of you have appointment books or date timers or things like that. Just put the slot in, hey, I had to go over and manage my properties during this window. Just put it in as if it was an appointment. And try and make sure you're getting to 750 hours a year because they'll take it electronically. That's fine. Okay?
What about all the tax apps that are out there now for regular expenses, for mileage, for all that kind of stuff? What's your opinion on those?
I haven't found a good mileage one yet. Although in theory, if they did it based on GPS and hey, I'm in my car, that would be great. But haven't seen it yet. I'd love to see a good log. But,
Bunch of them with GPS.
yeah, do they give you a log they'll print up at the end of the year and give you?
I don't know if you can print a log, but with the GPS ones, a lot of times I'll be driving around all day and then I'll look down and notice that it clicked out somewhere, so it's not that way.
Yeah, and that's a problem because if the app shuts down, it loses what you're doing, and you restart your phone, you forget to start the app back up. You know, there are issues with that. Certainly, that's better. This one, there's an actual pointer on this thing, right? Yeah. I'm more concerned with this one than I am with the car log, especially for realtors. It comes down to credibility. In any of the audits that I've dealt with, the car log is like the last thing they get to, right? When they start to look at all your stuff and they say, can I see this receipt? And you show it to them, you say this receipt, show it to them. When they get to the car log, if you've been credible the whole way and the car log seems reasonable, they're like, yeah, okay, boom. Whether you have a log or not, they literally just pass. They're like, okay, this taxpayer looks like they're being legit. I don't have a problem with them. If you've lost credibility, you're not going to get anything, even if you have a car log. They're going to say no and throw the whole thing out just in spite. Okay, so generally speaking, it pays to be credible, to keep your receipts and other kinds of things as you go for what you're buying, so you can justify what you've done. If you're credible when you get audited, you'll be okay. Okay, last thing to cover on this one. This is an annual qualification. Unlike passive versus active, which allows you to qualify, like if you've been active in any of the last 5 years, they treat the property as still being active. Every year you have to qualify to be a real estate professional. So if you want to take your real estate losses against your ordinary income, you have to qualify to be a real estate professional every year, or you won't be able to do it. Okay? Let's see what this does for you. Okay? Right. Most real estate throws off losses, tax losses, because of the depreciation and the leveraging and other stuff that goes on. And it can vary, but unless what I see with my base of clients, and generally speaking, is unless they are rich and paid cash for the property, which happens, and they basically just make rents and it's just basically a better return than they can get from the bank or the market, and it's steady and it appreciates, most people have leveraged their property. And that leveraging takes them usually from a position where they have a tax profit to having a tax loss because of the depreciation and the lack of the mortgage and the mortgage interest. And so most of them have losses coming off of their leverage from their debt finance property. And so for every $10,000 of losses this throws off, for a typical realtor who's making about $100,000 a year, many make a lot more, some make less, but for that one they would save over $3,000 in federal and state income taxes. So if you've got a property that's throwing off $20,000 a year in losses, you could save $6,000-7,000. If I save you $6,000-7,000 in your tax return, you're always thrilled. So, this is an important thing we bring up with clients. Are you a real estate professional? What's your facts? We'll quiz you and kind of go through the facts and see whether or not we can massage you into this particular classification. Okay? Any questions about real estate professional? It's basically a really cool thing if you have rental properties and you can qualify. But it's tough to qualify, and you better be prepared to defend yourself if you do. Not a bad thing. Audits are not bad because they don't happen that often, but we do have to talk as if they were going to happen. The truth is that the IRS last year was really proud. They said they audited over 1% of all 1040s. And I will tell you that number is viciously misleading. Okay? That would be 1 in 100. Included in that number, 90% of them are people who have no clue what they're doing when they prepare the tax return, and they're basically sending notices out to correct. They call it a desk audit. Anytime they send a notice and say, this number's wrong, they include that in their audit stats. The truth is, your chance of getting audited are more like 1 in 1,000. Okay? And if you prepare your return cleanly with things that make sense and aren't egregious, right? Hey, I didn't have 150,000 car miles. I'm a realtor, I had 14,000 car miles, and your expenses and everything look reasonable. They're not going to likely identify you. Okay? The real estate professional one is one that they've been going after. But if you have enough properties and your description is realtor and there's no other job that you do, it's still very unlikely they're going to audit you if you fit the profile. If the tax return tells the story right, you will probably not get audited. Okay? You just have to make sure the tax return tells the story right. All right. By the way, this is probably the most biggest piece of lightning that I caught when I was out there. I was basically down in Ma'alaya taking these pictures. And basically what you do is you set the camera on 30 seconds, right? And you have it open up the shutter for 30 seconds and you hope lightning comes along, right? And then it often does. So I took like 100 shots and I got about 7 or 8 good ones. It's kind of fun. And you notice that it's sky lightning, because if it was land lightning, like it was hitting that point out there, I'd be packing everything up and putting it in the car and running away, okay? Because it's very dangerous. But this was all sky lightning over the South Bay there. It was freaking gorgeous. And what happened was I pushed the button on one and I walked over to my car to get something, right? And I'm kind of fumbling around for a different lens and I'm coming back over to the camera. And I hear the camera click off, and literally the very next second, the best lightning of all went up across the thing. And there's dozens of people down there watching, and they all went, oh! And I went, shit, because I missed it. It literally was 5 or 6 times bigger than that one. It covered the entire bay from the point over to Kihei. It was stunning. I'd never seen a lightning bolt like that before in my life. It covered the whole sky, and I just missed it by a second. But there's some pretty good lightning. I moved around a little bit too, but I had fun with it. And it was a good, fun break story from watching this stuff. So the next topic we're going to talk about is some rental property deductions you don't want to miss. Now, these had some pretty dry topic headings, accountant design topic headings. And for RAM, they strongly encouraged me to punch them up a bit. So this one, more than any of the other ones, may not live up to the punchiness, but we'll do the best we can with it. Basically, we're going to go as a series of rental deductions to make sure you have a pretty good idea, if you have rental property, what a legit deduction is, what kinds of things you can find, and other things that can help you. Okay? All right, so just a general intro. A rental property is just like any other business. The most important thing for you to give your tax accountant is some sort of P&L, profit and loss. Here's how much rental income I made. Here's the expenses that I had during the year. And you give that to us, and then we take that, we put it in the Schedule E, which is basically a series of small P&Ls, and we report your net income. And we usually calculate depreciation and a few other things for you as we go, okay? All right? There's also a discussion there of general excise tax, which is due on gross rents. Everybody knows that, right? Everybody knows what a TAT is, right? That means it's 6 months or less. Pretty clued in on most of that stuff. So we're going to go with that one, okay? Now, what about the expense of acquiring the home? You asked about this before, and I kind of answered it, so I won't cover it in a lot of detail. But basically, any of your costs to acquire that home, the closing costs, the legal fees, anything else like that, is included in the cost of the home. And normally, when you buy or rental property, when you buy one, we want to see the HUD-1. Because we're basically going to pick and choose numbers off of there and put them in the right place. Some of them go into the cost basis of the home. Some of them go into the mortgage financing that we can then amortize over the note, which might be different from the depreciation on the building, which is a different rate. And we pick and choose those to put them in the correct place. Interesting thing about land is it's not depreciable. By the way, anybody know what depreciation is? Anybody have a question about what that is? I see no confused faces there? Okay, so I won't cover depreciation in any detail. But land isn't depreciable because in theory it doesn't lose value or wear away. Okay? All right, so what is recapture? If you know about depreciation, then you need to know about recapture. Now, fortunately, for real estate, recapture is less of an issue because it's called Section 1250 property, which is probably not worth covering. But essentially what happens is if you bought a property for, I wonder if he's got a ticker here. Here we go. Got an example. If you bought a property, sells a property for $150,000 on the basis of $100,000, right? During the time the seller owned the property, they deducted $25,000 in depreciation. So what's their new basis if they deducted $25,000? Anybody do the math in there? $75,000, exactly. Okay. Now, when you sell that property, we actually have to record that gain because your basis is now $75,000 and you sold it for $150,000. We have to report that gain in 2 different ways. The piece that was previously deducted as depreciation, we have to treat as a 1250 depreciation recapture. The other 50 is definitely a long-term cap gain. Whether or not how that 1250 gets taxed is different. Most real estate has a very broad exception that treats it just like long-term cap gain. But like if you were selling this desk is considered ordinary property. You have to pick that up as ordinary income tax rate. So if you'd fully depreciated the desk, you sold it for $100, that's ordinary income, it's not long-term cap gain. Okay, and that could be a big difference if you're selling big properties, because the long-term cap gain rate is 20%, the ordinary rate is 39.6% in the top brackets. If you're having a big event, big tax event, it can make a big difference. Okay?
If you know you're gonna sell it in a few years, it'd be better not to take the depreciation?
That's a very good question, and the answer to it is no. And the reason why is it's depreciation allowed or allowable. That's the standard. So if you forgot to take depreciation in the year you were supposed to, you lose it permanently. Okay? Yes, you might as well take it while you can. Right? Now you can elect into slower depreciation methods though. You can elect to take a typical rental property is 27.5-year property. You can elect to make it slower under some alternative methods. But you'd have to know way in advance that that was what you're going to be selling it soon and you didn't want any recapture. And really it becomes a rate play, what I call a rate play. Is your tax rate this year higher than the tax rate's going to be next year? Because if your tax rate one year is 39.6% and the year before it was 15%, I really want to move deductions to when you're making 39.6% because I've immediately saved you another 24% in taxes. That's a permanent difference in terms of what you had to pay on that income, right? So we get into rate plays and other things. So that's a much more complicated question than you think, but the answer comes down usually to when is the best time to take the deduction, okay? All right.
Excuse me,
Yeah.
depreciation is taken on a straight line method?
It depends on the type of property. Residential property is 27.5-year straight line. Commercial property is 39.5-year straight line. Okay? The desk is 7-year modified accelerated cost recovery system, otherwise known as MAKERS. It's a variation of double declining balance over a 6-year period. Half the first year, half the last year, but it's 8-year property. Half the first year, half the last year, and then the rest in the middle. So you get a chunk up front, you get a big chunk in the year 2. Usually year 2 is the biggest year, and then it starts to fade away after that. Okay? But one of the things that you can have go on is something called a cost segregation study, where when you acquire or build a property, what you want to do to get the depreciation deduction as soon as you can, because frankly, a deduction of the building 40 years from now isn't worth squat today. Okay? So what you try to do is say, hey, the desk is 7-year property, the sink is 7-year property because it's removable. You know, in theory it can be that, you know, everything you possibly can in the building that you can make removable, you do, so it has a shorter life and you can accelerate how fast you can depreciate it. Okay? There are companies that actually specialize just in cost seg work, but generally I've seen the project's got to be over about $10 million before you hire them to make it worth your while. Otherwise, your local accountant can usually handle it just by, you know, going over the invoices and things like that. Okay. All right. All right. Let's move on. What else is deductible against rental income? Okay. Repairs. Okay. The biggest question when you're dealing with repairs is whether it's repair or improvement. Okay. An improvement is something you have to capitalize and depreciate over 27.5 years or 40 years. Okay? So, but a repair is something that you can deduct immediately. Classic example is a roof. When you change the roof completely, you've just extended the useful life of the property substantially. The roof was starting to leak and starting to damage the property. The roof was dead. The building was going to die soon after. You put a new roof on it, you've just extended the roof life. It's a new piece of property, 27.5 to 40 years, depending on the type of property. If the roof gets a hole in it and you patch it, that's a repair. That you can deduct immediately. Okay? So, a lot of gray in there. There's been a lot of court cases on that. And the truth is that based on all these court cases, a lot of the gray's actually been removed. But in practical purposes, a lot of clients come in and say, yeah, that's a repair. And we just take, we're not auditing you, we take it for granted. But usually you're going to find is the bigger ticket items are the ones that you're trying to justify. You usually bury a certain amount in repairs and you go with there. One of the flags that I have to watch for when I'm reading a tax return, and I'll give you a little basis here. The way we work in my office, we're a firm, so we work on different levels. You have a manager who's your primary point of contact. There are 2 partners, there's like 7 managers, and there's another 7 or 8 staff. The manager becomes your primary point of contact because my partner and I are really busy. And you don't really want to deal with us on day-to-day stuff. So they collect your information, they put a tax return together, and they put it in front of me. Actually, I get a PDF of your entire return. And I sit down in front of that PDF cold, on purpose, without knowing what's going on. I just read it, looking for things that would attract my interest if I was reading it at the IRS. And one of the things that would attract my interest, that's a flag for me, is how big is the repair number? Hey, I've got a building that's throwing off 24 grand a year in rental property, and they spent 8 grand on repairs. Did they just buy it? No. What went on there? Okay? That's a flag. It's like, the IRS is going to see that as well. And so I may ask a question about it. What was this? What went on? Can we justify that? It's something should be capitalized, right? Because more often than not, like let's say there was a $4,000 roof repair and they didn't replace the roof, they just patched it, and the other one is ordinary, I might tell them okay. But if there was 7 or 8 grand of something that was new that should have been capitalized, I'll suggest they do it. And part of the reason I do that is because an audit can be more expensive than the cost of representing you in an audit, because they've got an easy thing, can be more expensive than anything else. What I notice that the IRS goes for in returns, and this is classic, if it's not one of the ones that was done to do a statistical sample, in which case they look at everything in it and write a huge complex report so they can statistically assess, and I've fortunately never had to deal with one of them, but I've talked to peers in the community who have, they're painful. Most of them are selected because of the simple concept of how low does that apple hang from the tree. Okay? If they look at that return and they see something that they've already got you on, they will audit you. Because they already know they have a positive winner. And then they get to look at you for everything else as well. So you want, when I look at a tax return, I look for low-hanging fruit. What is an obvious loser? I don't want to have any issues there. Okay? And so repairs are one of the ones I look at. I'm looking to make sure there's no low-hanging fruit there for the IRS to go, oh, I want to audit these people. Okay? Because my mission in life is to minimize or eliminate audits of my clients. Okay? We talked about improvements, okay? And sometimes I don't read slides, as you can tell. I kind of get a hint of what they're talking about, and then I expound on what I know and what's working. But you can see things that would be examples of that would add to or improve the value of the property, right? Okay? Record keeping. Okay, so this is a really interesting one. I always like to ask a question here. How many people think that recap that they get from Amex at the end of every year is enough to take care of their expenses, to document their expenses? It is a trick question, but I'm just curious. Anybody think that that's good? Okay, good. Somebody's trained you well. Because the answer is no. Okay? We have a lot of clients who think, hey, it's on my credit card statement. I'll just highlight the charges on my credit card statement and then you'll be good, right? And we're like, well, we'll claim it for you, but if you get audited on it, you have to justify it. Okay? What the IRS wants to see is receipts. Okay? Because they want to see the Home Depot receipt and see that it's not for a cooler and a keg of beer or whatever they can buy there, but it's for something that makes sense that went with the house, the building, or something else that you're doing. Okay? So they want to see receipts. Okay? If you're not keeping, and one of the simplest ways to keep these receipts or keep records for your rental properties that I think exists doesn't involve QuickBooks, okay, or anything else like that. It basically involves a file folder. If you can fit your year's worth of receipts in a file folder, my suggestion is to do that. Be religious about putting a receipt in the file folder. Okay? When you're done at the end of the year, get a nice big table like that one over there and spread them out. Gas, repairs, improvements, ta-da, okay? Then take that tape and add it up, run a tape with the machine, staple it right through the whole clump. Write that number in an organizer for us and we're good to go. Why is that great? Because boy, if you get audited, I'm going to be done with that audit in an hour. Okay? That auditor is going to come and go, I want to see these rental properties or these repairs. And you go, you open up I like the Priority Mail Tyvek bag because they last forever. You open up that bag and you pull out the thing, and because it's a staple, not a rubber band, it stays for 7 or 8 years because rubber bands are gone after a year and they're a mess. And you give it to him and he flips through it and he goes, okay, boom, done. Okay? If you're keeping it in QuickBooks, sure, he'll look at that, but then he'll say, okay, I need to see some of these receipts. And what he'll do is he'll say, I want to see these 20 receipts. And then you got to go through your records to find those 20 receipts, because what he's doing is sampling. Okay? They will look at your numbers, and they will say, they'll look for ones that look juicy, and they'll say, I want to see these. And you need to produce that receipt. Okay? If it's already there, you're good to go. What's your question?
We use apps like Expensify or whatever, and then the app has a photo of the receipt.
Perfect. Good question. One of the questions that comes up a lot is a variation of that, which is, what if the receipt faded? Okay? Fresh from the auditor. The first time I went through this, I don't care, that's your problem. Photocopy the receipt if you need to keep it alive. So pictures are obviously good.
So like we can just show them.
A picture is great. Okay? Right? It's a great way to keep a receipt. If you want to take a receipt of every picture and put it in a folder, you're in the same place. It's a little harder to sort, though. But it could work. But Expensify, those kinds of apps, those are fantastic. Okay?
What about if you pay at like a local handyman cash
Okay? Are you paying them more than $600?
at times?
Then you're supposed to 1099 them. Okay?
What if it's different guys though?
If it's different guys that are less than $600, what I would do is get a receipt from them. Like an invoice or a receipt, have them mark it paid, something like that, some sort of contemporaneous thing. Now most of these guys are not doing that. You can make a handwritten receipt that says, I paid this guy $250 to mow my lawn today, or for my rental property, yada, and put that away. That's good. Don't have too many of those. What they'll seek to do then is to penalize you for not 1099ing them, which is if you knowingly don't do it, which is pretty much a given, it's a $500 penalty per. So if there's a half a dozen people that you didn't do that and they can go back 3 years, they can hit you for 9 or 10 grand in penalties.
What if those guys just immediately throw away the 1099?
That's their issue, not yours. Right? If you 1099 them and they don't do anything with it, that's their tax issue, not yours. You 1099 them to fulfill the obligation. If you pay them $599, you don't have to 1099 them. If you pay them $600, you have to 1099 them. That's a light switch.
They're getting paid for escrow, does that?
That's not your issue. Well, yeah, escrow in theory is supposed to 1099 them then. And escrow will. They'll ask for a W9 or I think it's a W9, and make them fill out their information, so escrow will 1099
It'd
them.
be technically safer for us to do than wanting to keep it.
If you want to keep it under the table, then yeah, it's safer for you to do it. I mean, there is a black market economy. I can never recommend it, but it does exist, and it's very real. Okay? Let's see, what's on this? Let's see if we cover this, okay? So, receipts, very important. And so there's two sides of the deduction, right? One is proof of what it was purchased for a business purpose, and the second one is proof of payment, okay? So like if you got an invoice from this guy, but you have no proof of payment because you paid him in cash, that's why I want you to have him write on there, paid cash as confirmation that you got paid. That's the best type of information. If you paid him with a check, you can show the canceled check. If you paid by credit card, you can show the credit card statement. That's good. But if you have anything else, it may not be sufficient. Okay? And again, a lot of this comes down to credibility. Most receipts from Home Depot and other places have proof of payment as part of the receipt.
Maybe it's better just never even to use the word cash.
Yeah, the reason I pause, it's an interesting country. I mean, we're basically founded by tax protesters. The Boston Tea Party is the triggering event for the American Revolution. And so cheating on a person's taxes is as American as apple pie, but I can't encourage it. So I'm going to decline to give you advice on how to answer that question. But I can sympathize with it, but you have to decide what you want to do. I'm trying to tell you the correct way to do it. If you have somebody under $600, you don't have to. If you want a receipt for them, it would be good if they gave you an invoice and they signed off on it. If you don't 1099 them, your penalty is X. Okay? That's essentially what I can share and tell you about what's going on. Okay? All right. Vacation homes are a little tricky. Okay? How many of you have a vacation home that you use? Okay? This is more going to be advice for the people you're selling vacation homes to then. Okay? One of my favorite pieces of advice to a vacation homeowner is not to stay in their own darn vacation home. And we're going to learn why as we go through this set of slides here. Okay? The reason why is if you use it for more than 14 days, the math as to what you can deduct drops precipitously. Okay? Up to 14 days, you're good. After that, change units with some other owner in the same place. You go stay in their unit and pay them, and they stay in your unit, they pay you. You trade days, I don't care. Stay out of your own unit. Why? And we're going to talk about that as we go through, right? Okay? If you use it for less than 14 days, it's as if you didn't use it at all. It's not a personal asset. Any of the expenses related to it, if it's also a rental property, are fully deductible. That's the basic rule. The moment you get to the 15th day, though, the ratio changes. And it's not what you would think. You think, hey, I don't get to deduct 15 over 365. That would be a nice fair ratio, right? The rest of the time it's out for rental. No. The IRS has decided that the denominator is going to be the total days of use. Okay? So what did I use in this one? 75 days. It got used for 75 days, which is common around ski areas, maybe less common around here, but ski areas that's a pretty common ratio for ski area. Look at how badly they get hurt, right? They can only deduct 60 over 365. All of the empty days are presumed to be personal use days. Don't have your people stay in their own units more than 14 days so they can deduct the whole freaking thing. Now, it's a vacation home, so they can still deduct their two biggest expenses. They can deduct mortgage interest and property taxes, but they can't deduct the association fees. They can't deduct the electricity. They can't deduct the insurance. They can't deduct the repairs and maintenance. They can't deduct any improvements or repairs they make to it or other things. Okay? If they stay in it for more than 14 days, the ratio goes out the door. Okay? Now, I have a phrase I like to use that you can get a better, in my profession, you can get a better answer if you go down the street to somebody else who either doesn't know or doesn't care about the rules. Okay, you're going to get a bigger refund. This is one of the most ignored rules I've ever seen. There's another real big whopper in your same thing, and I'll talk about that one in a minute, but I hate to bring it up. Maybe I'll have you turn the camera off, but we'll bring it up. I see this one ignored. And when we get tax returns from our peers in the community or vacation homeowners who bring their returns to us, usually foreigners because they usually have their people at home do it, more often than not I see this rule ignored. They stayed in it for 15 or 16 days, they pretended they didn't, and they deducted the whole thing. But this is a real rule, and you can get smacked around by this one if you actually follow the rule. And so I like to warn people about it. More than 14 days in your own vacation home is a bad idea if you're renting it, because you lose a lot. Now if you're renting it, if you're only staying in it 14 days and it gets rented a lot, you're not going to miss much. Maui is one of those places where, gosh, you can rent it 240 days, 300 days. You can stay in it a month because it's a busy place. It's a year-round vacation destination. But in a place like a ski area, 60 days of rental in the winter is pretty common. Okay, that's what you get it for. The rest of the time it sits empty. And so it becomes an important scenario in terms of what you're doing. Okay? All right.
Now, how do they identify if you're staying in it or not?
Well, here's where committing tax fraud comes into play. A few years ago on the Schedule E, there was nothing that indicated what was going on. Now they basically make you state on the Schedule E how many days you use it for personally and how many days it was rented. It's a required statement on the Schedule E in order for them to assess. Now if you lie there, right, that's tax fraud. Remember the 3-year versus 6-year rule? If you fib there, it's a 6-year rule.
What if you paid rent?
Huh?
You paid their nightly rate.
You paid the rent to yourself? That's not going to work. It's not. If it was owned by an LLC, maybe. But most of the time not. Maybe. And I'd have to think about that one because most LLCs are disregarded entities. You'd have to be a partnership where you and somebody else partnered to own it and you paid rent because you were staying there. Then you'd be okay.
So what if you're using it 20 or 30 days a year and you're renting it 300 days a year? Again,
The ratio won't hurt you as much because you've got 300 over 365. It's just the days that you lose are the empty days. The empty days are presumed to be personal use days. And so if that ratio is skewed, right, where you're not renting it that much, a lot of expenses don't get deducted. Because I'm going to take an expense, like let's say association fees, right? And let's say they're $1,000. For this particular scenario, the association fees, I'm going to get to deduct $164. If you don't stay in it at all, I can deduct $1,000. Okay, that's that's a big difference in terms of what's deductible based on the example that's on the board.
But again, say theoretically the 300 over 365, then you're still doing pretty good.
Yes, you have a much better ratio. You're going to deduct 300 over 365, which is like 85%. You're not going to get hurt as much. But, you know, every empty day counts against you. So again, if you have a low-use property where you're renting at 120 or 180 days or less, or maybe even 200 or so, it might, and you don't come out here that much, it might behoove you to like not stay in it for more than 14 days. Find another place to stay.
I'm your exception of the ski property.
Yeah? You have a ski property? So are you running into that issue?
Well, we're definitely using it more than 14 days a year, because we go out 2 to 3 times.
Yeah?
But I'm pretty sure we're...
Deducting the whole thing. That's very common. It's one of the fibbing on a tax return is a pretty common thing. I can't encourage it. We tend to be the CPA firm that helps people change the facts to change their tax. We will go to you and say, I'm sorry, this year we can't sign it that way. Next year, why don't you do this so you don't get into any trouble? And you know when that pays dividends? When our clients get audited. It's like, we just sail right through. Also, it reduces our risk of audit because the auditors by now, most of the local ones, know that we're not playing games unless somebody's playing games with us. So we tend to do pretty well that way. But it can vary. You know, I mean, it's one of the local preparers a few years ago, Jim Erickson. I can speak about him because he's basically been in the news. He's basically committing criminal tax fraud on every return he was doing. And when they saw the pattern, they basically audited every single one of his clients. Not only did they audit his clients, but they strongly pressured them to testify against him. Okay? They subpoenaed them and did other things to make them testify against him. It was a very painful thing. We cleaned up a bunch of clients who'd been with him.
We do long-term rentals, and we actually have a verbal agreement with our tenants that we can use the unit during their rental period for 7 to 10 days.
Mm-hmm.
So we're actually staying in their rental period. How would that qualify?
Is this a standalone house or is this a
Condo.
It's a condo. Are you good friends with anybody else in that condo association?
Yeah.
Okay. Have a chat with him. Bring this issue up and say, hey,
Swap.
okay, can I pay you to stay in your unit? You pay me to stay in mine? And
Unfortunately, he's got multiple units, so he can stay in one 14 days, another one 14 days, another one.
exactly. Unless he's grouped them because he's a real estate professional. But yeah. Okay. So this is an issue that comes up and it gets ignored a lot. Okay. But you got to be careful of it. Okay. We try to do the right thing on this one. All right. Other things. Don't miss these. I'm just going to go through the list real quick. See if there's anything on this list that you went, oh, hey, I didn't know about that one. I basically threw a whole bunch of stuff up here. I was basically thinking of everything that I've seen deducted because this was sort of how I got back to the original thing. Hey, don't miss these deductions, which is basically more of a general discussion of what's deductible, what's not, right? Okay. Remember, I noticed I said careful about the management fees. Okay. Business use of home, yes, and we're going to actually talk about that later in more detail. But don't miss some of these things. If you're traveling to your property to take care of it, don't miss those. Okay? Like when you travel with your family to your ski thing, you're going to be doing some work there. Your trip costs, to the extent that you worked on it, are deductible. So like if you go there for 7 days, you spend 2 full days working on that property or dealing with issues with that property, the cost of your travel there, 2/7 of it, is deductible. Don't miss that.
I think the whole thing.
Well, in theory, if it's mostly, if you break more than half, good luck with that one. You're deducting your kid. Don't admit the tax fraud.
Really like a third is 20% to a third is kind of what you say you should.
You should deduct the actual time that you're spending on the return. I'm on camera here. You're trying to get me to lose my license?
Oh, okay. Sorry, I didn't know.
Okay? You have to deduct the portion that you're doing that's legitimate work. You can deduct it. If you actually go there for 7 days because it needs a major repair and that's all you're doing, deduct the whole thing.
Right.
Okay? As long as you have at least a work week there, like 40 hours spent working on it, then you can deduct the whole thing. You don't need to spend every minute and sleep there and everything else in that per way. But if you actually get a productive work weekend, deduct the whole thing, even if you're having fun in the evenings or anything else. That's not so much of an issue.
What
if you're just like skiing with the client?
Uh,
Somebody you actually don't deal with and you're spending days with them.
Okay, yes and no. Okay, if you're entertaining an important client, like you're trying to rent it for a festival, and somebody, like let's say there's a movie. I'll give a scenario. Let's say there's a movie festival there, and you want to rent it for like 8 times its value during that 1 week period, and some guy's coming to talk story with you about doing it, some movie producer or something, and you take him skiing that day to bond with him and make arrangements for him to rent it for the next 5 years that way. Great. But if you're just going there to hang out with your regular guy, the standard that we're breaking is what they call the ordinary and necessary business expense standard. It's a very broad standard, and it basically says you can deduct anything that's ordinary or necessary for your business. But if it's extraordinary, like, hey, I want to go and ski, so I'm going to drag my tenant along with me to go skiing for a week to entertain him, it's not ordinary and necessary because that tenant wouldn't have needed that inducement to rent your property. Okay? But if you're trying to sell a guy on paying you 5 times its worth during the Aspen Film Festival or something like that, and you want to line him up for the next 5 years, then you might have a good story because you're trying to make a big sale at greater than market for what you're doing, right? And do extra things for it. You can write off the whole trip if that's what you're doing. Well, entertainment expenses are technically 50% deductible, meals and entertainment. But the travel to get to your client, yes. But the actual entertainment, which is the skiing, the meals, and the other things, 50%.
So it's theoretically a season ski pass if you're talking to people in the gondola every ride up about buying property?
I can't even begin to touch that one. I'd have to think of a scenario where you could sell that one.
Okay.
Maybe. If that's how you're meeting your clients and you can demonstrate, literally, if that is the only way you meet people to sell properties, and you give them cards and that's the only place you're meeting people and you're skiing every day and meeting and closing properties that way, I would say you actually had a legitimate argument. Okay, because gosh, you got them locked in the same chair with you for 5 minutes. Hey, and you're always talking story. Getting that time can be very valuable. It's at times. I wish it would work for CPAs because I would like to do that. But you have to be careful. It's going to be looked at funny. You better have a good story. You better show, hey, I sold 80 houses last year and I met 70 of them on the ski slopes. I got 70 of those listings on the ski slopes because I'm on the slopes. And when I go when the big ticket money people here on the weekends, because that's when, even though it's busier, because that's when the money people are here. Those kinds of things. Yeah, you have arguments and you can justify it. I can get that one through. I'll make that argument with the auditor, but it better be reasonable. Okay, and that's really a stretching one. Okay, but it can make sense. I mean, getting locked in for 5 minutes is good.
Are you going to ask whether their client's names or is that going to be kept confidential?
Yes. Okay, you're going to want to be able to justify, I spoke to this guy. So get a business card from them or get a contact from them. Or better yet, if all you did was hand out a business card because you were at a function like this, anybody who came from that business card, have it printed different so you can say, you can identify the people you got from it. Okay? Because like if you came to an event like this and you paid money to come here to be part of an entertainment event or something, you're entertaining somebody, it's a little different. His is not necessarily, which makes me wonder whether it's meals and entertainment. We're going to get way off on the side here. His could be a prospecting expense, which would be fully deductible instead of half. Because if he took a client he already knew skiing, that's meals and entertainment. But now that I think about it, it's more of a prospecting expense. It might be 100% deductible, like coming to this event and handing out business cards, or going to a Maui Chamber of Commerce event, meet and greet, the monthly events where you meet and greet. That cost is fully deductible because you're networking. Okay? If he's using it as a networking expense, it might be fully deductible. Okay? But if he takes his client that day, no. Okay? Plus the pass has an annual value. There might be some pro rata. Like if he goes skiing with his family someday, I'm going to have to do some ratio that says, no, he didn't use it. It gets, yeah. This is interesting, but not necessarily all that realistic. Any questions about any of these items that are up here? Okay? No? Okay, let's move on to the list not to take. Don't take these. Oh, these are all separate? They're not supposed to be separate. They're supposed to all come up at once. Okay? So, pets. How many stories I've seen people trying to deduct their pets. My wife wants to deduct the birds in the yard because she uses them to advertise for her bed and breakfast. No. Kids, no. Okay, daily meal. So if you're going to lunch every day, even though you're at work, no. Okay, clothing, no. I don't care how nicely you got to dress for your business. Dry cleaning, no, not deductible. If you have your logo on the shirt, yes, then it's a uniform. Otherwise, no. Okay? Racehorses, yachts, no, not unless you have a profit motive. Race cars, vacations, no. Again, don't deduct that. Tattoos, no. Dues and subscriptions. Not the business ones. You notice over back here there was I'm not going to go back because there's too many. Dues and subscriptions was listed on the last one, but those were business dues and subscriptions to business organizations and business publications. A subscription to Time Magazine or others wouldn't be unless it's going in your lobby or something.
Specific business news?
Yes, business related. Okay? But yes and no. See how something can be in both places? Depends on the purpose. Legal fees, again, that was also listed in the other one. All those last four, it depends on what it's for. If you're getting sued for something, legal fees are generally not deductible, but if you're trying to protect an asset or if it's business related for contracts, yes it is. Okay, it goes in different places. Bank fees, personal bank fees, no. Education, new field, no. Okay, so if you're a realtor and you decide to become an appraiser, right, the education to become an appraiser is not deductible. If you're already in the profession and you're taking education to maintain or improve your skills in the given profession, yes, that's the difference. Okay? Yes?
Daily meals. As long as you have anybody with you, theoretically, you're talking business.
Okay. Yes and no. Okay? Right. The justification for meals has to come down to, there's a couple of standards. First off, there's the documentation standard. You have to have a receipt. You have to write who you were meeting with and what the business purpose of the meeting was for. That's the documentation standard for meals and entertainment. The next standard has to have a reasonable and necessary business purpose. Okay? If you're taking somebody to lunch every day because you're networking and the storyline that these receipts tells is a different person every day, then yeah, you're okay. But if you work in the office with your wife and every day you go to lunch and talk about the office, no. Okay? So it depends. I'm not going to delve down a different, I'm just giving you a couple quick examples because we're going to run out of time if we keep going on some of these ones. Okay? I really like this one. Okay, the way it wrapped around and did things, and you can't get the perspective on this projector because it doesn't have enough pixels, but literally it's far and close. It was kind of cool. Anyway, so the hidden tax deductions on a HUD-1. We talked about this a little bit briefly. Since we did, I'm going to kind of go through it pretty quickly. The HUD-1 statement is filled with little line items, and they seem confusing, but as a tax accountant, I got to know what everyone is, and they go to different places, okay? Attorney's fees for sellers go into the cost of selling. For buyers, it goes into the the cost basis for the house, okay, or the property, okay. Any attorney's fees associated with obtaining a mortgage are not deductible, and the exception we talked about earlier was unless it's for a business property, and then it becomes deductible as a cost of obtaining the loan that you amortize over the cost of the loan. Okay. Any other fees in connection in case of buyer basis. This is generally written from a personal property and not necessarily a rental property perspective. If it's a rental property, some of the deductions are more enhanced. Okay. And I guess we're covering that. Attorney's fees associated with obtaining over life, any other attorney's fees or connection go into the basis of the property. Okay. All right. Closing costs, credit reports, appraisals, VA funding fees. They're deductible selling expenses to the seller. Okay, they go into the basis of the property for the buyer, and if they're renting it, then they can sometimes amortize over the life of the mortgage. Okay, commissions, a selling expense for the seller. It increases the basis for the buyer if they happen to be paying them. Usually buyers don't pay commissions, but sometimes they do. Okay. Okay, again, these are items that are only deductible if the property is used for income. These issues come up because the only thing that's deductible for a personal residence or a vacation home are property taxes and mortgage interest, sometimes PMI, okay, or points. Everything else is a personal expense. It's not deductible, okay, unless you've got a rental property. Okay, and then everything becomes deductible because it's something that you did in order to acquire the business to rent. Okay. Miscellaneous items. Again, selling expenses for the seller and buyer's basis in the property. So what I love to see on tax returns, I don't know how many times I've seen this, where I see a home, hey, I paid $400,000 for that home or $150,000 for that home, and that's all you list. I will tell you that on a selling of a home, the price of the home is never $150,000. It's always something like $154,647.19. You will never, even though the home price is this, when you get done doing the HUD fees and doing it up, it's always got other costs in it. When my clients buy or sell a home, we want the HUD. And we have something called the perm file in our office, which remember we talked about we get every 7 years we get rid of files? Well, we have a perm file. Everything that goes in the perm file doesn't get disposed of for that client. So we have the HUD one for everything they buy and everything they sell. Because guess how long you got to keep that HUD one when you buy the home? For 7 years and after you sell the home. Because when you sell the home, you're trying to justify your basis in the home. So if you buy the home and you sell it 30 years from now, you better have the HUD one 37 years and 38 years from now. Okay? That's especially true for any improvements you do on the home. If you improve a home, something that goes to the basis of the home that you want to use as a cost, keep all of those records for as long as you own that home plus 7 years. Okay? All right. This is a recap sheet of settlement costs because we're running behind. I'm not going to spend a lot of time on that one. Okay? Any questions about that? Okay? All right. When you're dealing with a good tax accountant, they should always ask for the HUD one. If they are not, they're not doing their job correctly, in my opinion. And I've seen some that don't. They just say, yeah, okay, whatever you say, right? They tend to be the ones who do it for $150 and not for $600 or $700 because we get it and then we got to spend an hour analyzing it. But we do take care of it. Okay. Let's see. The minefield of the home office deduction. Yes or no? I'm going to come down usually on the side of yes, with a couple of exceptions. Okay. If you're using any portion of the home for business, you can deduct it. Okay, with some caveats, rules, and gotchas, and we're going to talk about those. Okay. The first gotcha is you have an office, you got a couch in it, and you use it. It's in a room that's 10 by 10, so it's 100 square feet, and you let your nephew sleep in there one night while they're visiting. You just lost the whole office deduction. Okay? If you admit that to the IRS agent, it comes down to this, what do you say and what do you not say? Okay? It's one of those classic reasons why when my clients do get audited, I don't want to put them in front of the IRS agent. All it takes is one innocent thing that they don't know about because they don't know the business to admit to, and they're done. Right? If they say, yeah, my nephew slept in there one night, that's not a big deal, is it? Oh yeah, it's a huge deal. You just lost the whole thing. Okay? It's crazy, but that's how the rule works. Okay? It has to be used exclusively and regularly for business. And exclusively means any transient use at all voids it. That's literally one of the biggest lies made anywhere, but as long as you don't fess up to it, we get away with it. And Congress has actually greatly relaxed these rules. IRS strictly interpreted them. There was a case called Solomon, and the Congress was so mad at them after they won this case that they relaxed the rules even more. And what did the IRS do? They proceeded to come up with subtle little ways to crank down on them again. I don't know why the IRS hates the home office deduction, but they do. But Congress doesn't agree with them. So you can push a little bit back here and usually get away with it. Okay?
What if theoretically your spouse has a desk and a computer in your office as well?
And is she doing a business or is she doing personal stuff there?
Both.
If she's doing anything personal there, it technically voids it. If you're doing anything personal there, it technically voids it. Okay? And again, this comes down to not putting your client. The basic rule of thumb here is don't put your client in front of the auditor. Okay? Because the auditor will ask me and I'll say, I think it's used completely for business, but I'll find out. Because I can say I don't know. Okay? They told me it was completely used for business, but I'll find out. I am not lying to him. You would have to lie to him, which is a criminal offense, if I put you in front of him. If you were trying to maintain that deduction, or you'd have to tell the truth, which you'd lose the deduction. Okay? And to some degree, there's a bit of gaming here. I don't like the gaming. I wish the rules were fair and reasonable so that small amounts of use didn't disqualify it. And in fact, Congress passed rules that said small amounts of use didn't disqualify it. But in practice, what I've seen is the IRS is still trying to enforce them, okay? Because they own, the way Congress wrote it up, because, you know, it's 535 people trying to agree on something. The way they wrote it up, it was for certain specific situations, and if you don't fit those situations, they kick you out again. It's tricky, so be careful with it. All right, so principal place of business is normally very exclusive with this exception, okay? This is the one I was just talking about. If you don't have any other place of business, they give you a little bit of a break there. Okay, so if you don't have a realtor's office some other place you're working, you're only working from your house and your wife's got a desk there, you might be okay. But if you have another location, you might not be. And again, what I'm finding, because the rules, I'm giving you a very simplified version of these rules, my general approach is to fall back on try to use it exclusively and keep it that way. It's safer, okay? It's like the 750-hour rule for the real estate professionals. Keep a log, keep it safe, okay?
How do you calculate the percentage of your house that's attributed to the house?
A tape measure.
Square footage.
To do your tax return, you need a tape measure.
So no, but is the garage included and all this kind of stuff, or
I generally,
say the living space?
I actually don't ask about the garage. It doesn't come up much unless somebody happens to be using it for a business like a plumber. It's not uncommon that the garage is
Storage?
the most important part of the house being used for a business, for a lot of repair and other type businesses. The garage becomes the dad's, you know, workshop.
What about all your signs and brochures and boxes of, you know, collateral and all that kind of stuff that you store in the garage?
In theory, no, because it's not exclusively used. It's an area of the house that's used exclusively. However, there are exceptions, okay? You might qualify under one of the exceptions, but again, I'd be careful, okay? I'm cautious about the facts around the home office, but I'm not actually cautious about taking it. And we're going to get to that in a little bit, okay? All right? What I've kind of come down to in trying to summarize these pages of rules that between Congress and the IRS going back and forth in the court cases is it's likely to be challenging if you have any other place you can conduct business. If you don't have any other place you're conducting business, you have a broader and easier path to justify it. But if you have another place, it's going to be harder. It better be exclusive and it better be specifically set aside. If you're an employee using a home office, they're going to likely to challenge that, okay? And if you're mixing business and personal in the same room of the house, they're likely to challenge that, okay? All right? Consult your tax advisor in those scenarios. Okay, so what's deductible? Just about all of the costs of the home, right? So your association fees, your repairs, your maintenance, your internet, your, I'm trying to think, you know, the insurance for the house. Okay? If you have a 1,000 square foot house and a 100 square foot office, 10% of all those costs get deducted. Okay? Right? So, certain things, some things are directly deductible. For instance, the business phone line, okay, is directly allocable, but most things are allocated based on a ratio. Okay? Again, it's some sort of mathematical way to allocate the expenses after you've summarized them. Okay? Also, the portion of your home, if you own the home, that qualifies to the business has to be depreciated, okay? So you get a little bit of extra deduction from that one, all right? Okay, and to take the land out of the value, it's just the cost of the house, okay? A couple of observations here, okay? Home office deductions for homeowners are sometimes not worth the trouble. Why? Because they're already deducting the two biggest expenses, property taxes and mortgage interest. So now we're just taking some small percentage of all the other miscellaneous things like insurance and repairs and maintenance and other stuff. And so oftentimes trying to get that information, I'm going to get an extra $300 deduction. And it, you know, $150 an hour to repair a tax return, and the benefit, it's like not worth it to try and drag that information out of the client. If you're a renter, though, it's a done deal because you're not deducting any of that. Rent isn't deductible. So when you're a renter, being able to deduct 10% of your rent, or whatever percentage it is, becomes immediately much more valuable. Okay? So, and it depends. There's also the scenario where you have two different businesses, where you have the person is doing business as an S corporation or an LLC or something like that, and then they're using the business, and it's separate, and they're renting their home to that entity, which gets into GET taxes and other kinds of issues, but it is one of the other issues that comes up. Okay? I joked about this already. You got to do your tax return with a tape measure, but that's actually the most accurate way to do it. One of the flags I look for on the tax return, again, goes to credibility when I'm an agent reading it. What's the square footage of the house, and what's the square footage of the office? If I see 200 over 2,000, I don't like that. I like to see 132 over 2,356. Why? Because that looks like somebody actually went to the trouble of measuring and doing the measurements they were supposed to instead of guessing. It's a reflection of the accuracy of the tax return when I'm looking at a return for things that I would flag. Okay? All right. Let's see what else we got. Home office does not equal an audit. Right? The IRS wants you to believe so hard that a home office equals an audit. But the truth is, they do audit an awful lot of these, but so many of these are so badly prepared. It's the number one place where you leave low-hanging fruit for them, that I think the average taxpayer leaves low-hanging fruit for them. If you make sure it's not low-hanging fruit, I don't think they get audited anymore. I've never seen an audit picked just because it had a home office in my entire career. I've seen real estate professional picked just because they were a real estate professional. That one I've seen, but I've not seen a home office ever picked just because it was a home office. They picked it because there was something on that return that screamed at them that this was a baloney deduction. Okay? Like 70% of the house was the business, or something like that. Okay? All right? The other thing that it does for a lot of people is I think it actually justifies your business deductions. Okay? A lot of people who are still in their home, working out of their home, generally are going to be the newer people in business, the ones who are having less success in business. I hate to say that. Okay? Because they haven't reached the point where their business has grown to the point where they realize, I got to get out of here, the wife, the kids, and the dog, I can't work. Or the spouse, the kids, and the dog, I can't work. I need an office, right? I mean, So the home office deduction actually adds to the story that you're telling with the tax return that you're really trying to make this work. I have a room dedicated to this business. It's a full-time occupation. I think it sells the other deductions, in my opinion, as long as the story's told right. Okay? And I think that's it. Any questions?
I'm going with that. You're mentioning as a homeowner taking the home office deduction because of the property tax and mortgage. How does it? Why are you saying that it's not worth it?
Okay, let's use an example. That's probably the easiest way to go, right? You have a house, right? And we're going to do our mortgage interest is, let's say it's $24,000 a year. Let's say it's a little over $2,000 a month thing. Your property taxes, and we'll say it's in Hawaii. All right? Let's say this is, let's say it's $2,000 because it's a nice round number, easy to work with. Okay? Now let's add up the other stuff. That's a big number. You got $26,000 right there. That's the single biggest expenses to own the home. Now what else is left? You've got utilities, okay, insurance, right? Repairs, association fees, okay, and let's say this is 500V6. Let's say this is 1,000, 2,000 utilities. Let's say we've got 3,000 insurance. Let's say it's 1,500. Let's go repairs at 1,500 because we get nice round numbers. And let's say association fees are $3,000. Okay, so I've got $9,000 there, right? Okay. Now, if my home office is a typical real number for a home office is about 10 by 11. So let's make it 10 by 10 because it's nice. So I've got 100 square feet. And a typical house is 2,000 square feet, right? Okay. I've got a 5% number of that is the extra deduction. And I'm going to have to pull teeth getting this information because it's not business expenses. Okay? The business expenses, internet, they're keeping track of that because they want to deduct everything they can. So they've put internet in their business line. They've separately stated that for me. I'm going to deduct 100% on Schedule C anyway. It's already there. All I'm getting is a little percentage of this. And I'm moving this deduction from page Schedule A to Schedule C or some other place. Okay? So this doesn't provide that much value, because again, I'm only getting 5% of this one. Right? So you get the deduction, because the ratios, the key here, I think, to having a realistic home office deduction is the ratio here needs to be realistic for what you're doing. For a realtor, it's going to be low. For a plumber, I've seen 35, 40%. Because literally they got an office, they got a garage, they use the yard to store bigger stuff. I mean, I've seen some pretty big percentages, and if you go look at their house, all I need to do is show them one picture. Okay, you're good to go, right? Because you've got a much bigger percentage. But most small businesses, realtors, things like that, you see, 10% of this is $900, 5% is $450. The $450 for a typical 25% tax rate, I've now saved you $125. And I'm going to spend an hour collecting this information and reporting it. It's not getting to be worth it. So I'm finding for a lot of homeowners, unless this ratio is big or these expenses are really huge, that generally we're starting to negate it. Plus, there's something that happens to these homes. It tends to be rare because when they start to grow and start to become successful, A, they move out of their house, or they incorporate, and now what they're doing is they're renting a section of their home to the business. And so now I get a deduction, but now I got to pay general excise taxes on the revenue I'm getting from the business because it's a separate entity, and it just becomes a complicated mess. Normally, this is the piece you're trying to capture and deduct somewhere, and by the time you get down to the deductible percentage, it's not worth the effort anymore. Okay? That's what I'm finding. It doesn't mean it's not a legitimate deduction. I think it is, but how much is it worth to dig for? Okay? Any other questions? Okay? I'm sorry, go ahead.
I get a question. You know when the kids the parents turn over the property to the kids?
Yes.
When they get older.
Mm-hmm.
What is the basis? Do you need an appraisal done at the time?
Are they gifting it, or are they leaving it to them in a as when they pass away?
They're giving it so that they can avoid going to Halamakua and paying the $8,000 to $12,000 a month.
Okay.
So 5 years.
Okay, so they have to give it to them 5 or 6 years beforehand.
Right.
Okay, so they're probably using a device called a why is the name leaving me now? It's a certain type of trust where they get to retain the ownership of the use of the property, but they've basically given it to the
Lease
kids.
back.
Yeah. Okay. Sometimes they lease back, sometimes they don't. Depends on what Medicare or whatever is asking for right now. The kids get the basis that their parents had.
Really?
Yes.
Oh.
The downside to that is they do not get a step up in basis when the parents pass away. Let's take an example, because again, examples are good. This is a really good question, and I don't see, there is an eraser here, right? Suppose you have a house that is, the parents bought in 1970, and they paid 50 grand for it, right? Wow, this does not work at all. All right, let's pick a different color. It might actually come out if I need it to come out. Maybe black will come out better. So they paid $50,000 for it, right? Back in 1970, right? There's 2 different ways to get it to your kids. One is while they're alive. That's a gift, okay? Actually, 3 different ways. The second one is when you pass away. That's part of your estate. When you gift it, they get a carryover basis. They get that basis, okay? If you gift it in 2014, if you will it to them when you pass away in 2014, they get a fair market value basis, which could be worth $500,000. Okay? That becomes your kid's basis. There's no tax on that because they acquired it when you passed away. Okay? The third way is to sell it to them. Right? And if you sell it to them at anything less than fair market value, the rest is considered a gift. But usually if you get close to that number, nobody's going to argue about it. Okay, you can sell it for less, $400 or $350 maybe, and nobody would care, But you can sell it to them. This is the third way. That was the third way that I was thinking of. But gifting and bequeathing are 2 different ways, and they have a different tax effect. Now, bequeathing is generally better if the value of the parent's estate is $5 million or less, because there's no estate tax. When it breaks $5 million, then they're going to have to pay a tax. The estate has to, when they transfer it to their kids. And you can actually make it 10 if it's a married couple with a little bit of estate planning. But generally speaking, you're going to get your parents' basis. Remember the HUD-1 that you had to save for 7 years? Well, now they got to go back and find their parents' HUD-1 from when they bought it, plus any improvements that they've done during the lifetime that they lived in that house. Then they got to keep track of their own stuff until they eventually sell it, because they have to do the basis. You know what we end up doing? We end up guessing. I warn them, do you have any clue? No, I can't find anything. My parents don't have any records. Nobody's got anything. I'm like, okay, well, what did the property tax records say then? Well, we kind of get some close number of what we thought the value was at the time the parents bought it. That's the best we can do. So, in many cases. But it's better if you have the records. And you had it.
If you set up a living trust, would the fair market value, would the basis be the fair market value when you set up the living trust?
Yes. That is what he's talking about, and this is the issue we're thinking in the living trust, is if you take the home, right, and you stick it inside of a trust, right, what the parents keep is the right to use it, okay? Life estate, that was the word I was looking for, which is a type of trust, okay? It's a type of the trust you were talking about. It's a variation of it. What they call is a life estate. They give the home, goes in here, and then the kids, right, get the property when they're done with it. They call that a life estate, okay? The value it transfers, the value when they put it in the trust, because the parents no longer own it. Only thing they kept was the right to use the property for the rest of their life, okay? This life estate goes at that value, not this value, okay? So when the kids sell it, they have a $450,000 gain, okay? All right. Do you remember a few years ago there was a trial balloon? Remember that term from earlier today? Congress was debating getting rid of the estate tax. When I read the details in that rule, they were basically going to hose all of the people who didn't have an estate tax. What they were going to do to replace the estate tax was they were going to take away the basis step up when you passed away. So essentially what they would do is give a lower tax rate to the rich and pay for it on the backs of everybody who was just inheriting their parents' house. Everybody would only get that basis. So when they did sell it, they'd have to pay the $450,000 tax. That was how they were going to work that one. That was a tax the poor and give to the rich tax scheme. That's why it probably died. It initially looked important, but it kind of died. The estate tax is people like to call them death taxes or, killing the family farm taxes. The truth is they're sort of necessary because wealth accumulates. And when somebody passes away, it's a good time to redistribute the wealth. Otherwise, you end up with the Good Earth scenario that was part of a Pearl S. Buck book a long time ago where the landowners owned everything and everybody else was a serf. So they have to redistribute wealth. The question is at what level? And at the time, for several decades, the estate level was like at $600,000, which is really low. What they effectively did finally was agree between the Democrats and Republicans to make that level $5 million. So that everybody gets a basis step up, and only those people who have estates worth more than $5 million have to worry about the estate tax. That means the really wealthy have to redistribute the wealth and not necessarily get every dollar of it into the hands of their kids. And I think overall that's a good piece of social engineering, because otherwise it would all rise to the top and it wouldn't be so good for us over the course of it would only take a couple of generations for all of us to be serfs again. So, in my opinion. Any other questions?
So the basis does change when the parents pass away?
In the trust situation, no. The kids get it with the $50,000 basis. Because it's the basis at the time they put it in the trust, which was the parents' basis. This is a gift, basically. It was a gift in the form of a trust. They gifted it to the kids, and they retained the use of the house for the rest of their lives. Okay? And that goes in at $50,000. I'm sorry if I wasn't clear. So, but it's a $50,000 because it's a gift, right? If the parents passed, right? Like another way to do some of these is when they pass, they create a trust, and the kids get to use it for their life, but the grandkids get the house. That would get a $500,000 basis set up because they didn't even set up the trust except as part of their will when they passed away. Okay? That would be a scenario where that trust actually got a basis step up, because what you did was put post deceased property into the thing. Okay? One of the things that you can do, because spouses don't always pass away at the same time, is that you can have you can set the trust up when the first spouse passes away, so you can at least get a half basis step up. When they pass away, they put their half in the trust to the kids, and the other one then gifts their half in, and then you've got at least a half basis step up. Okay? Because that's about the time that, mom or dad is within a few years of moving on to Halemakua or something like that anyway.
Business use of car, acceptable parameters?
It really comes down to the ratio and the type of business you're in. I find realtors can deduct up to 70%. It's pretty useful.
Up to 70?
If they only have one car. If they have multiple cars, I'll take 100 for a realtor. But it depends also on your location. If you're working from home, it's a bigger ratio. If you have a place that you're working from, you go to every day, that ratio goes down. Because the commuting expense to get to that location every day is not deductible. So like the first trip there and the last trip home, not deductible. But if you're working from your home, that's your base, then you're basically one of those realtors that live in your car, right? And realtors work from their car. It's your office, right, in most cases. So I get away with a lot for realtors. But plumbers, they're driving around with their truck. They got to go to the location to do the work. Accountants, I'm not so lucky. I'd be lucky to get away with 5%. Okay, 10% would be a max for me because I work from my office, right? I'm like the driving miles. Hey, I drove over here, and I drove back to my office. That's it. I'm not really in front of my clients or meeting in the same way that you do. It's a different nature of the business.
So kind of building off of that, based on the car, like if your car's parked in your garage, does that mean you can tape off or measure off like your car area, square footage?
I would.
Solely use your car for business?
No, because if you solely use that car for business and never use it for anything else, you might have an argument. But if you used it even just a little bit, then you've got that mixed personal and business use again, right? And now you're storing an asset with a mixed business personal use. You don't get any deduction for that square footage at all because, again, it's that the IRS hates it when you're mixing the space for business and personal.
So you're better off.
They want exclusive use.
I mean, if you have multiple cars and you're at home office and everything else, you still may be better off taking 90% versus 100 just to.
Well, if you really are using one car for business and the other one, like your favorite car to drive around is a Vet, and when you're driving yourself personally, you use the Vet, it's a two-person car, completely useless for real estate. And you have a four-door car and you don't like driving it because it's like a Buick or something, it's a good realtor car or whatever, and it's like, then you got a good story. You see how the story supports what you're doing? I'd say 100% on the Buick and nothing on the Vet, and that's a safe way to go. If your real story is that you're mixing it, you're really supposed to follow the facts. Okay? And we're in a scenario here where we're making up stories to fit a set of facts where you could, where you couldn't, but really it's your story. If you have two cars, how are you using them? That's what we're supposed to report. Okay?